QuickBooks Pro Plus Desktop 2022 OneNote presentation. Enter billable time and add to invoice for a job. Let's get into it with Intuit's QuickBooks Pro Plus Desktop 2022. If you have access to OneNote, would like to follow along, icon left-hand side, topic introduction 7300, enter billable time and add to invoice for job. Tab. Also take a look at the immersive reader tool. Topic introductions in the text area too. Same name, same number, but with transcripts. Transcripts that can be translated into multiple languages and either listened to or read in them. Same name and number as presentations as well. Topic introductions designed to give an introduction to the topic. Provide screenshots, links where applicable. Give accounting background to complement the presentations and can be used to follow along with them if you don't have access to the software at that time. Closing the icon on the left-hand side, we got the screenshot that we're going to be starting out with. We're focused down here on the enter time, which is basically just going to be a spreadsheet that's going to be entering the time that you could use then to populate the employee wages when you're calculating, say, hourly salary. But we're going to be using it here to populate an invoice, which might be a system you would expect to see in something like a law firm or a CPA firm, a tax firm, where you have staff that needs to track their billable hours, assign them to a job or to a customer, and they can do that in here, or we might have some other system where we're going to track it just in an Excel worksheet or something like that, and then we're going to use that information to create the invoice so that we can bill the client based on the work that has been done and assigned to the particular job and or customer. So if we go to the trial balance, we're going to be focusing in on transactions that will be entering the time and then basically creating an invoice, which will have the standard transaction for an invoice, increase in the accounts receivable, other side going to revenue on down below. Here we are inside the time sheet. So we're going to say Erica Smith, this is our employee. We're entering her time, not so that we can process her payroll per se, although we could use it for that purpose, but we want to do this for the billable time so that we can charge it to the customer. So she's going to be putting in here that this is the customer and the customer job 3005. And then the service item that we set up a service item by our staff, and we're going to be charging by staff at a rate that's going to be consistent to the staff member, noting that you might also use other methods and have the staff basically charge what is the activity that they did and possibly charge some rate by the activity. So those are the two kind of methods that you might use if you have this kind of setup that was going to be working for you. Then we're going to say we had 8 hours on Friday and 8 on Saturday. They are both going to be billable. They're going to be billable to the client and the job of 3005, which is a job attached to Jones Guitars. So if we scroll down and then create an invoice for Jones Guitars, we're going to pull in the information. QuickBooks is saying, hey, I'm paraphrasing here. I have information that's billable for it. You want to pull that in? We're going to say, yes, we do. And then we have the Erica rate at the 8 hours. I'm sorry, that's the quantity and the rate of $100. And there is our invoice that has been populated from the billable timesheets. This would be increase in accounts receivable. The other side going to revenue. No impact on the inventory because we're not dealing with any inventory in this case. So then if, for example, if we go to the checking account now, we can also use this billable kind of theme in order to enter something into, say, a checking account and make it billable. I don't like this option quite as much, meaning this is us entering a check. The check will do what a check normally does, decrease in the checking account, the other side going to office supplies, but we're also going to add the customer over here and the job and make it billable so that when I create an invoice, it will pull this in as well. The problem with this method, however, is that you're not using an item. So when you invoice it, it's not going to record it in a sales item. It's going to have a reimbursement, a negative kind of expense, which isn't really what you typically want. So what you'd like to do is use items in order to enter this billable section. So be careful with that. But if you use this method and you invoice Smith again, you're going to say add the information. We've got the information on the item here and the time. I think we have both of those to add. So here's the expense and the item. And so now we've got the rate for Erica, 8 hours, and there's the 100 and the 130 here for the reimbursed item as well. What's this going to do? Accounts receivable is going to go up by the 930, which is what you would expect. And the revenue is going to go up by the 100, which is what you expect. But the 130, because we use that billable item and it's not assigned to an item, this one is not. It's just using that billable. It's going to be a counter or negative expense like a reimbursement, which is not really exactly what you want most of the time. So what's going to be the impact? Accounts receivable is going to be impacted here, and then we had the sales and the expense that are impacted down below. This is where that key factor is. It basically lowered the office supplies back down in there, and this is the service revenue that we can see, the 800 for these two items in the 800. Here's the funny one. In office supplies, we got this negative in office supplies. We got a reimbursement of the expense. It's the same impact on net income, but you really want to see the revenue and then the expense, right? So it's not ideal typically for most reporting purposes. So if we go back in here again, and let's say we entered another bill, but this time I'm going to go to the second tab and make an item. I'm going to try to do it the correct way so that when I pull this information over, it's going to then create an invoice that will go to an income account and not an expense account. So when I create the item, I'm going to make it a non-inventory item. That means it's kind of like an inventory, but you're not tracking it within the system, so you're not going to actually track the item. We're going to use this little tab here, which says this is used to assemblies, and that gives us our option to basically be able to record this both sides of the transaction, because we're recording the expense side, which we can kind of use this item, which normally is cost of goods sold. And then on the other side, it's going to be the income side, which we can use this side over here for the office supplies. So it looks like a setup for, in other words, an inventory item, but we're using it for kind of a different purpose in this case. So we're going to say the cost, I'm going to keep it at 0 here and just enter the cost when we enter it into the system. The expense account is supplies expense. So when I expense it, it'll go to supplies expense just like we did before, but this time we're going to do it with an item. And then over here, I'm not going to put any sales in it because I want to put that in ourselves. There's no sales tax involved, and it's going to go to the service revenue account. So now when we record this, we used an item, recording the same thing with an item of office expenses, not just the office expense account. And now when I pull it over, because an item is used to the invoice, it will then populate properly and go to an income account. So I'm going to pull that over, create an invoice. It will then pull over that information just like we saw before. And so now we've got the same information for office supplies. It looks pretty much the same as that office supplies component, this increase in accounts receivable. The other side, however, not being a decrease to office supplies, but rather going to an income account because we used an item in order to do it. So that would be the more proper way to do it. It's a little bit more complex to get it done that way, but I think it's worth the time to do it because then it's going to be going into the sales item up here or service revenue instead of decreasing like an expense account on down below. So if we go into the service revenue, there it is in the 200 right there instead of a negative supplies. Here's the customer balance details so we can see the information that has been put in place by the customer supporting the accounts receivable. If we were to do the same kind of thing, basically by hand, or just look at the debits and credits, you can also just think about basically having someone, your staff, if you're like a partnership in a law firm or a bookkeeping firm, just enter their payroll into like an Excel worksheet, right, on a weekly basis or a monthly basis or every 2 weeks, and fill out the billable hours and the jobs that they worked on. And then you would take that information and say, okay, they worked 8 hours. I'm going to charge $100 for them. Therefore, 8 times 100 would be $800. The invoice would simply be doing this, debiting accounts receivable, credit going to the service revenue. If that was going to impact the financial statements, accounts receivable goes up, and then we've got the service revenue would go up. Looking at the general ledger accounts, it would be $12,757 for the AR before. We increased it by 800 to the 13,557. The service revenue was at the 5,180, up by 800 to 5,980. Then we look at the accounts receivable subsidiary ledger, which was impacted by that $800 down here for Jones Guitars, now owes us $5,399. If I add up the ending balances for all of the accounts receivable, it adds up to the 13,557, which ties out to the 13,557 up top. Then if we take a look at this again, we're charging the office supplies now for the billable item. This would be kind of the same kind of thing as we saw in QuickBooks when we charged the billable item, that we tried to then link the expense, the check, to the to the invoice. So when you just wrote the check, it would be the normal transaction, debiting office supplies, crediting the checking account going down, the office supplies going up, decreasing net income. Here's the office supplies was at 500, went up by the 130 to 630. The checking account was at the 8911. It was at 89,141, down by 130 to 8911. And then we had the transaction. This is pulling over just like the transaction we saw in QuickBooks that is recording the revenue, which was for the second customer, the $800. And we had the office supplies that we then billed. And this would be the same as us basically using the invoice to pull over the billable item from the check. And that would be then saying that the accounts receivable goes up to 930. So it would be just like that invoice that we created that was charging for the time as well as the billable item. However, the billable item, this is the funny part down here, is crediting the office supplies because it's acting like a reimbursement, mirroring what we did in QuickBooks when we didn't use an item. And so what happens here is you've got that, this is that funny case, the checking account, this is going to be the 930 in the accounts receivable, the 800 is going to be down here in revenue, and then you've got this office supplies netting back out instead of going to a revenue account. That's kind of the funny thing. So if I go to the accounts receivable down here, we would be at the 13,557 before, up by 930 to the 14,487. And over here, we were on the revenue the 5980 up by 800 to 6780. And then the office supplies went from 500 up when we actually wrote the expense to the 630, which is what you would expect. But then it went back down as a reimbursement. This shouldn't really be here. You shouldn't have a negative office supplies. It should be a positive revenue account. Normally, that's the problem when you're using the billable items. If we go down here to the accounts receivable, we have this item in accounts receivable of 930. So that was Smith right here. So Smith owes us 930. If we add up all of the customers that owe us money, it adds up to the 14,487, tying up to the 14,487 up top. So then let's do this one more time. This time we're going to do the second method like we did with, like as if we were using the item to do it in a proper way. This would be the transaction related to the check that we made. Office supplies being debited, checking account being credited. So office supplies going back up, checking account going down for the expense. We're imagining it that we made it billable, but this time setting up an item so that we don't have a negative expense when we bill it, instead having a revenue account. So office supplies goes up, and we see the checking account then goes down. Then when we use that to bill out, this would be similar to us using the items in QuickBooks. We get the proper kind of invoice that you would expect, a debit to accounts receivable and a credit to the revenue account, not a credit to an expense account. It's not a reimbursement. And to do this in QuickBooks, you would have needed to basically use the item. That's why we're saying that the item is what you basically want to do. So the accounts receivable then going up, and then we got the service revenue, which is going up. Looking at the GL accounts, we got the 14,487, and then it went up by 200 to the 14,687. And then the service revenue was at the 6,780, up by 200 to the 6,980. Here's the subsidiary ledger, and this is for $200, which we charged over here to Jones Guitars. Owed us 5,399, up by 200 to 5,599. Adding up all the customers adds up to the 14,687, which matches what's on the GL and trial balance.